I recently had a viewer of the channel ask me, could I make a video describing how to trade the ES futures or the MES futures? Specifically, he's asking about options on futures. And how do you trade the S&P 500 in a smart, profitable, consistent way? And obviously, the most obvious answer to that is just go sell some puts, right? Because the S&P 500 just goes up over time. And that's what most people are just going to tell you. Just go sell some puts. But sometimes you need to be a little bit more strategic than just doing the same thing over and over again. So let me switch over to my trading platform. Of course, I use TASTYTRADE as my trading platform. And let me go ahead and take a look at the S&P 500 index, the SPX. And if we take a look at a chart, you can see the SPX just tends to go up over time, right? Historically, it has a positive drift, right? It's always heading up. I mean, there are down years, of course. You get the occasional down year, but it's very, very rare for the S&P 500 to have 2 down years in a row. That's a very rare event, and 3 down years in a row I think has happened. I think the dot-com burst was the only thing that stopped it for 3 years, right? So most of the time, the S&P 500 is just going up. So it makes sense for capital efficiency because you get such great buying power relief to play the S&P 500 using the futures products. The big boy product is the ES futures. And if you want something a little smaller, the MES futures are the S&P 500 futures, but 1/10 the size of the ES futures. Now, because the S&P 500 wants to go up all the time, right? One of my favorite things to do is to actually just sell puts on it. Now let's do a back test. Now we can't back test the futures products themselves because each futures expiration is its own separate product. They don't match, right? The prices are different from each futures contract to the next. So we have to come up with a stock equivalent. I'll use SPY. So it's the same, right? SPY tracks the S&P 500. I'm going to do a 5-year back test, and let's do a test on a short put in SPY. And one of my favorite trades is to do this in the ES or the MES. What I'll do is I sell one 10 delta put at 90 DTE, and I exit the trade at 21 DTE or at 50% max profit, whichever one comes first. And let's go ahead and put this on. I'll do this every week on Friday for 5 years, and let's see what the results of this back test are. Now, in practice, I'm not going to sell one of these every single week, but this is just to get a nice back test here. So we've got a number of occurrences here. And of course, because I did so many trades, there's a lot of trades, right? Every week for 5 years, you know, the back test is going to take a few minutes. But you can see overall, we've got 32.5% return on capital using SPY. Now, remember, when you use the futures, you get much greater buying power relief than you do on SPY. So realistically, you're probably, this return on capital will probably be twice what you're doing here in the SPY back test, maybe 3 times. So, you know, it's a really, really profitable strategy, right? Because the SPY, it just goes up. If I move my head out of the way, you can see that in 5 years, we had the one losing trade there, the one losing trade there, and then the market meltdown this year where you had 5 weeks. Now, realistically, you're probably not losing on all of those because after the first big down move, you know, when that market meltdown back in February started to happen, you're probably not selling naked puts, you know, for a little while. You're going to wait till the market actually signals that it's coming back up. But, you know, the back test is a mechanical back test, and we're going to keep all the trades in it. But still, this is a great back test, right? On average, you receive a premium of 283. So in SPY, SPY is twice as big as MES. So in MES, you're going to receive an average credit of 140 per trade. On ES, it's 10 times the size of MES or 5 times the size of SPY. You're going to receive $1,400 premium on average on the trades. And you can see you profit 97% of the time, right? So 97% of your trades profited. And realistically, I'm just telling you, you probably wouldn't have lost on some of these here. Like human beings, we're emotional. I'm going to stop selling puts for a little while after I suffer that first big loss in there, right? So, but then again, also we're emotional creatures. There may have been some weeks where I didn't take a trade for whatever reason as far as some of the winning trades. So it all evens out in the end. So because this trade is so good, it has such good positive expectancy, and especially when you use the futures because you get that extra leverage because of the buying power relief, why wouldn't you just do this all the time, right? Why wouldn't you just go into ES or MES? And if we go to the MES futures, this is what I typically do. I go about 90 days. I go find the 10 delta put. Sometimes I might go as low as 7, somewhere in between 7 and 10 deltas, but I don't want to go higher than 10 deltas. I really don't want to go lower than about 7 deltas either. So this is my average range, and I'm going to win, again, about 97% or more of the time on this. So let's do this 10 delta put here that's an even number, 5,900, right? I'm going to get $197.50 credit, right? Because it's $39.50, and the multiplier in the MES futures is 5. You multiply everything times 5. So $39.50 is really $197.50 credit. The buying power reduction on selling that one put, look at this, $216, because it's out of the money. It's got a lot of time still left on the trade. The futures use a portfolio style margin, so they give you much greater leverage. So when we go back to the SPY backtest, and you look at return on capital, you got to think, man, I'm getting such great buying power relief in the MES futures, and the ES futures as well, depending on which product you want to use. I might make 3 or 4 times the return on capital is what the SPY backtest is showing here. So if I go back to the options chain here, so this is one of my go-to trades. Every couple of weeks, I'll go sell some puts 90 DTE at 10 deltas. I'll sell 2 or 3 puts in the MES. It's my typical size on this, and I'll do it every couple of weeks. And at some point, I might have 8, 10, 12 of these short puts on. If you got a bigger account, if you're trading with several $100,000, do this in the ES. You'll go to the ES futures. Same thing. Go about 90 days, go 87 days in this case, is the closest I'll get, and find that same 5,900 strike and sell that. That's the 10 delta, right? $39.50 credit. Now the multiplier in ES is 50, not 5, because it's 10 times the size of MES, right? So you get $1,975 credit on a buying power reduction of only $4,500. It's just insane, the buying power relief you get on the futures. Now don't get suckered in on the buying power relief and think, wow, this is such a great trade. Let me go sell a bajillion puts in ES. Well, keep in mind, you're getting some buying power relief because of the portfolio style margin that the futures use. But when things go against you, this buying power is going to change drastically. If you get a market crash, this buying power is going to explode. Right? And all of a sudden, if you've got a ton of these short puts on, you could be facing a margin call where you don't have enough money in your account to maintain these positions. And then you're forced to close those positions that are underwater, right? And you could potentially lose tens of thousands, hundreds of thousands of dollars because of an event like that. So don't sell too many of these. If you're new to how futures options and the margin works, start small, start small until you get the hang of it. If I go to my positions here, if I go to my positions tab and look at all of my ES, MES stuff, you'll see I've got a lot of stuff going on here, right? Now, why do I have so many things? And these are not all short puts. I got a lot of long puts. I got a lot of put debit spreads, right? Long put spreads. What's going on here? Well, I mentioned that selling a lot of short puts in ES, MES, those things can be dangerous. At some point, you may want to hedge a little bit, or you may want to just kind of play both sides of the market on occasion. One of the ways I protect myself is a lot of times I will buy a really far out of the money put debit spread in ES. So what I typically do is I want to pay $100 for $2,400 worth of protection. So if I go to the ES futures here, let's go to the options chain. I'm going to go 90 days out, so 87 days in this case. And what I typically do is I go and buy a $50 wide put debit spread that costs $100. That's going to be somewhere around 7 deltas. Let me move it down. I want to pay an even 100 if I can find one that's an even 100. Well, this one here, 102.50 is close enough. So I'll buy this put debit spread, but I don't want to purchase a put debit spread this far out of the money that's almost certainly never going to pay me money, right? So if you pay $100 on this $50 wide spread in ES, because it's the multiplier of 50, it's really a $2,500 wide spread. So if I pay 100, then the max profit's 2,400 should I win on the spread. So it's a nice little downside hedge. It's downside protection, but it's rarely ever going to pay off. It's almost never going to pay off. You need a serious market event for this thing to ever make money. So I don't want to constantly be buying these things for $100 a piece, $100 a piece. You're just kind of bleeding money. So how do I finance this? Well, at the same time that I do this, I also, I will go into MES typically. That's where I go and sell my short puts. And then I go to the 87-day cycle here, and then I go load up on some of those 10 delta puts that I love to sell. So the 5,900 strike, remember, is going to pay me $200. If I put on one of those, plus that put debit spread that cost me $100, as long as I profit 50% on the short put, it will cover the put debit spread. And so if I take this off at 50% max profit, and it's going to make 50% max profit almost all the time, right? Remember, we win 97% of the time on this thing. So I'm going to get 50% easy. As long as I get 50% on the short put in MES, it pays for the put debit spread protection in ES. Now, realistically, I don't want to just break even. So what I need to do is I'll sell a few of these, maybe two, right? I'll sell two of these. So now I'm getting about $400 credit on the two short puts in MES. And if I take these off at 50% max profit, that's a $200 profit. Well, 100's got to pay for the debit spread in the ES. So now what have I got? Well, I've got $100 profit, plus I've paid for the hedge now in the ES futures. I hope that makes sense. So that's something I do when I want to protect myself a little bit. I just don't want to be selling nothing but puts. Occasionally, I will use some of my short put profit to pay for put debit spreads. I also sometimes use some of my short put profit to pay for long puts. And how do I do that? Well, I typically do that with ratio spreads. I can do this with both front ratio spreads and back ratio spreads. Here lately, I've been doing a lot of these back ratio spreads. I do these at 90 days. And typically what I do is I go and sell some puts. In this case, let's imagine that I don't already have this trade on. I sell 4 puts somewhere around 10 deltas is typically what I do. And then I go and buy some bigger amount of puts down around 2 deltas. In this case, let's make it 4 by 7 because that's the trade I currently have on. And, if I clear this off, let's actually take a look at the analysis on the trade that I currently have on. So let me turn all of the trades off except the 4 by 7 back ratio spread. It's a put back ratio spread, and I'm going to have to zoom way out because there's so many strikes obviously in the ES. Let's turn on the expiration. So what this is, here's my short puts that are at the 10 delta mark. Remember, I'm going to win 97% of the time on 10 delta short puts. So assuming that I win on the trade, right, I'm going to pay for these 7 puts. Actually, the way I have calculated this, typically I try to do the short puts versus the lower long puts. I try to do it in such a way that if I take this off somewhere between 50% and 75%, I can pay for the free downside protection at that point. Because if I take, for example, this off at 50% max profit, I have covered the cost of the 7 long puts that I'll then just leave on by themselves. And if I go back into my positions, I have stuff like this. I have these 5 long puts here. These were part of a 3 by 5 put back ratio spread, and the 3 short puts, just one. Right? I've already taken them off for the profit. The profit more than covered the cost of the long puts. This here was also another ratio spread that was 3 by 5. The 3 short puts came off. I left on the long puts. Here is another one that was, I believe, 3 by 5. And here is this 4 by 7. I'm only at 16% max profit right now on the short puts. But if I get to 50%, again, it'll pay for all of these long puts, and I'll end up in a situation where I have so many long puts on that I can sell more short puts and be covered in a sense, right? I'll have some protection. If I look at my P&L graph here in TASTYTRADE, and this is a P&L graph of just my ES and MES positions currently. The graph is not quite right here because it shows me losing money if we trade in this range. Well, I've actually taken off a lot of short puts for a profit, but because they've already been taken off, they're not part of the graph. The graph is just current positions. So I've actually, think of all of this as a profit area. I've already profited everything in this zone. I really don't start losing money until, in this case, say SPY drops probably 100 points, right, or better, is when I start losing money. And even then, I've got some protection because all those way out of the money long puts down here. So that is the secret, right? If I move my head here, I go to cap requirement. Let's actually take a look at risk analysis on my ES, MES positions. And let's imagine the market drops 20% and volatility spikes 30%, because that's what's likely to happen in a market crash. You can see my current ES, MES positions actually make money. I'm going to make $6 grand on my positions if the market crashes, just on the ES, MES positions right now. And that's partly because I'm kind of light on short puts. I need to start adding more short puts. So probably when the market opens tomorrow, I'm going to put on some more short puts because I got so many long puts now. I need to balance it out a little bit. I need to get back long, but that's the game I'm playing, right? I use some of my short puts because those short puts, they just tend to work. I will eventually use some of those short puts to pay for long puts or put debit spreads, some downside protection. And you just want to balance things out. You want to smooth out the ride. So when the market does have a downturn or sometimes a crash, or sometimes a very lengthy bear market, you've protected yourself a little bit. So, there's not so many huge bumps in the road. So to the viewer that asked me that question, I hope I answered some of your questions. Now, if you'd like to help support this channel and support some of the work I do, please check out my book, The Super Wheel Option Strategy. This book is available on Amazon. You'll find a link to it in the description below. That book is about my favorite option strategy, which is the wheel option strategy. Take care, guys. Peace.